If you had to choose between chasing the next hot tip or mastering a timeless principle, choose the principle. Trends fade. Principles compound. The fastest way to build modern wealth is to borrow the playbook of the ancients, then run it with today's tools. We live in an age of noise. Flashing screens, endless opinions. Everyone has a shortcut. Almost no one has a philosophy. Money without philosophy is like a ship without a compass. It might move. It won't arrive. Ancient wisdom gives you that compass. It tells you what to control, what to ignore, and how to behave when the sea turns rough. Picture an olive grower in ancient Rome. He plants, prunes, waits. Seasons pass. Some years are abundant. Some are lean. But he keeps tending the trees. He keeps his storage jars full for winter. He resists selling his grove for quick coin. Decades later, his land is worth far more, his yield is steady, and his family eats when others panic. He didn't have a Bloomberg terminal. He had discipline, margin, and patience. Those are not old ideas. Those are forever ideas. Here's the heart of it. Wealth favors the builder who can delay gratification, protect downside, and repeat good decisions long after the excitement fades. The ancients taught this in parables and proverbs. Modern finance teaches it in charts and cash flows. Same lesson, different language. Let's start with the inner game, because mindset is the lever that moves everything else. You will be tempted to react to every headline. You will be tempted to measure your progress by this week's prices. That's the trap. The Stoic frame solves it. Focus on what you control: your savings rate, your asset selection, your risk, your holding period, not the market's mood today. As Marcus Aurelius put it, you have power over your mind, not outside events. Realize this, and you will find strength. The modern translation is simple: control your process. Let returns arrive on their schedule, not yours. Once you adopt that frame, you stop needing constant action. You don't check your portfolio 10 times a day. You check your habits. You don't ask, what's the market doing? You ask, what am I doing that the market will reward in 10 years? That identity shift is everything. You stop being a gambler with quotes on a screen. You become a steward of assets in the real world. Now the money game. Principles first. Tactics second. Principle 1. Compounding beats intensity. Small, repeated advantages beat dramatic one-offs. Automatic contributions beat heroic, irregular deposits. A steady 10 out of 10 habit at 6 out of 10 intensity wins over a 10 out of 10 burst you abandon. Make your contribution a bill you pay yourself before you pay anyone else. Make it invisible. Make it automatic. Then let time do what time does. Principle 2. Quality over cleverness. The ancients honored craftsmanship. They bought tools once. They maintained them. They passed them down. In the market, quality is a business with durable advantage, high returns on capital, and leaders who allocate wisely. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, said Warren Buffett. That sentence has paid for a lot of retirements. Let it guide your watch list. Principle 3. Margin of safety. Ancient builders used thicker stones than the minimum. They over-engineered bridges. They planned for floods, not sunny skies. Your version is cash for surprises, conservative assumptions, and position sizes you can hold through storms. Margin of safety keeps you in the game long enough for compounding to matter. Principle 4. Play long games with long-term people. Naval Ravikant put it cleanly. Play long-term games with long-term people. In money, that means align with businesses, partners, and funds that think in decades. If the people running your capital live for the next quarter's applause, you inherit their time horizon and their mistakes. Let's make this vivid with a story. Asha and Leo both earn the same income. Both start with $5,000 in savings. On January 1st, they set New Year money goals. Leo downloads 3 trading apps, follows 10 gurus, and rewrites his plan every time a chart turns red. Asha writes a 1-page policy in plain English. It says, I invest automatically on the 1st of every month. I keep 6 months of expenses in cash. I own broad, low-fee index funds as my base. I add a small sleeve of high-quality companies I understand. I never sell because of fear. I never buy because of FOMO. I review twice a year. I will be here in 10 years. That's it. No magic. Just rules. 12 months later, Leo has stories and screenshots. Asha has more ownership. 10 years later, the difference isn't small. It's a different life. The market rewarded the one who behaved like a builder, not a tourist. Now let's translate ancient habits into modern systems you can install today. First, tally before trade. The earliest merchants kept ledgers on clay tablets. They knew what came in, what went out, and what remained. You need the same clarity. Track your savings rate, your contribution date, your asset mix, your fees. If you don't measure it, you can't manage it. Second, build the 3 jars. In the old stories, families kept separate jars for seed, food, and trade. Your jars are security, 6 to 12 months of expenses and cash-like reserves. This is your shock absorber. It stops a broken transmission from becoming a broken portfolio. Ownership, your long-term investments. Global index funds at the core. Add a quality tilt if you pick stocks or factor funds. Reinvest dividends. Ignore drama. Own for the next decade. Optionality, a small sleeve. Think 5% or less. For asymmetric bets you can afford to lose. New tech, early stage exposure, or a concentrated idea inside your circle of competence. If it hits, great. If it doesn't, your plan survives. Third, set default behaviors. Your future wealth is the sum of your defaults. When your paycheck lands, have your money move without asking your opinion. Contributions flow into the right jars. Bills pay themselves. Leftover cash gets swept to the security jar until it's full, then to ownership. Your calendar reminds you to review twice a year. Not every day, twice a year. Fourth, decide once about risk. Don't renegotiate risk in the middle of a storm. Choose it in calm. Write down your maximum position size. Write down what drawdown you can emotionally tolerate. Write down your sell rules before you buy. Selling should be mechanical. Thesis broken, better opportunity with similar risk, or a tax-aware rebalance. Not, I felt nervous on Tuesday. Fifth, read long. Ancient wisdom comes from long texts and quiet thought. Your edge today is attention span. Read annual reports. Read letters from great investors. Read history. Ignore dopamine headlines. There are no points for reacting fastest. There are fortunes for thinking longest. Sixth, use a pace you can keep. Wealth is an endurance event. Choose a plan you can stick with when life gets chaotic. The best investment strategy is not the one with the highest theoretical return. It's the one you can execute in bad weeks when you are tired, busy, and tempted. A small detour on lifestyle. The ancients warned about ostentation. They praised moderation. Modern translation: live below your means, even when your means rise. Upgrade your life slower than your income. Keep your fixed costs low. Flexibility compounds. Status does not. If this resonated, subscribe. Join a community that blends ancient wisdom with modern money. We build quietly. We own patiently. We think for ourselves. And we let simple, eternal principles do what they've always done: turn steady behavior into lasting fortune.